Slowing growth dampens India's prospect for fiscal consolidation. That's according to Moody's. The sovereign rating agency says that given the already weak credit profile, the possibility of higher lending will weigh on credit profile as well. Joining us now on the phone line is the Managing Director of Sovereign Risk at Moody's Investor Service, Moody. Moody, thanks so much for joining us. What are your concerns at this juncture as far as India's fiscal is concerned?
What we have highlighted is that the prospects for the government's debt burden, and government debt is currently about 68% of GDP, are reliant on sustained, relatively high nominal GDP growth. So real activity and some inflation in the economy. And that is because the fiscal consolidation, so really proactive measures by the government to narrow the deficit, is likely to be challenging. We've seen that for a few years in India, where there are significant spending needs and infrastructure and social and physical infrastructure, and revenue collection has disappointed. So the debt burden becomes really reliant on nominal GDP growth, and in the current phase of a slowdown, which we think is partly long-lasting, then what we are looking at is smaller prospect, lower probability of really a significant fall in that debt burden. Now we're looking at that debt burden to remain at around current levels for the next few years.
Marie, good afternoon. This is Ira joining you. Just wondering if you can share your view on the growth picture in India. It does look like you're seeing this slowdown is protracted. Domestically, the debate has been whether it's structural or it's cyclical. But I think the way you've put it is that it's at least partly long-lasting.
We do think it is partly long-lasting. There are multiple causes, really, to that slowdown, and some of them go back to a few years. What we've seen over the last few years is financial stress, in particular in the rural sector, with low food price inflation, which, while positive for the economy as a whole, has probably compressed margins for the agriculture sector, and that is related to some stress. We've also seen weak job creation, in particular amongst the young, with a rise in unemployment, and that is also contributing to compressing incomes and depressing consumption. More recently, we think that the growth slowdown is partly attributed to the contraction in credit availability from the non-bank financial institutions, where the liquidity squeeze in that sector remains continuous, and that used to be a sector that provided significant amount of credit to, in particular, retail credit, and so we've seen that slowing. We think that these factors are long-lasting in that there's no few prospects of really a rapid bounce back, a rapid resolution to this, and as a result, we've revised our forecast down. We now expect for this year GDP growth to be around 5.8%, and then to rise slightly in the course of 2020.
Marie, it was about 2 years ago that Moody's had upgraded India, and at that point there were some assumptions made both on growth and the contribution of certain reforms such as GST to growth and then also to the fisc. Would you say that 2 years down the line some of those assumptions have not played out as you would have expected?
So some of the and that's the case for growth, we just discussed. 2 years ago, there were prospects of sustained real GDP growth at around 7.5–8%. These prospects now have dimmed. There were also prospects related to that then of a steady decline in the government debt burden, and we think that it is now less likely. What has remained, though, and that is an important factor behind the rating, is the structure, the composition of the government's debt, that is in local currency, that is at long maturities, and that provides really some stability to that debt burden. On the downside, we think the stability in that fiscal consolidation is really challenging, but on the upside, in terms of a higher risk of a higher debt burden, we also see a relatively low probability of a rapid ramp-up because of that financing structure, because it is fairly predictable. The costs of the government's debt are fairly predictable because they are in local currency and the debt is at long maturity.
Marie, how does India compare to other peer economies? We heard the IMF chief talking about the fact that within the emerging market universe, the slowdown in India perhaps is a little bit more pronounced. Within your peer rating groups, how does India compare to others in terms of the growth picture particularly?
So the slowdown has been more marked, so going to now 5.8% this year, which would be 1 full percentage point lower than last year. When we look at other emerging markets in Asia, for instance, the slowdown is somewhat more tempered than that. It is, in the case of India, a slowdown from higher growth levels. 5.8% by international standards is still a very fast pace of growth, fueled by steady population growth and still rising incomes. It's also that the slowdown has really different origins. So in the case of India, the factors we've talked about are essentially domestic. It is not an economy that is particularly reliant on global trade, whilst in particular in the rest of Asia, what we're seeing is that the slowdown has a lot to do with global trade slowdown for economies like Malaysia, like Thailand, or other emerging markets in the region that are reliant on trade, on exports.
All right. Maria, last question. Do you also see policy space in India being a little limited? I ask because we've already seen the government expend some fiscal headroom via corporate tax cuts, which may not be immediately soothing for the growth picture. Also, the Reserve Bank of India has cut rates by more than 135 basis points now. So, terminal rates would probably be approaching fast. So is policy space limited?
So we've seen policy easing, as you just said, both on the fiscal and the monetary policy side. What we're watching for is really the signs of effectiveness of that policy easing. So on the monetary policy side, although the RBI has cut interest rates by 135 basis points so far, these cuts do not seem to be passed through, and so the cost of financing for the economy is not falling at the same pace. On the fiscal policy side, the most significant measure in recent months was indeed the corporate tax cut. We think that will have a slight positive impact on growth of around 0.1, 0.2 percentage point. Space beyond that, scope for further easing is constrained by the government's objective to keep the deficit at relatively contained levels, and the longer-term objectives to reduce the debt burden. We think these objectives are increasingly challenging to meet, but we think they do remain as policy objectives nonetheless.